In the next couple of videos, we're going to talk about financial performance. Um, this is probably better recognized as financial statement analysis. How do we perceive management's performance, right? How well are they doing the jobs that we have hired them to do as the owners of a company? So we want to first start with a basic ratio. It's called return on equity. Now, return on equity essentially is it's a measure of financial performance. It relates the profit of the company, net income, to shareholders' equity, right? And it sort of makes some sense, right? And if you look at the Hasbro company, their return on equity is roughly 29.6%. Now, does this number directly relate to price or wealth of shareholders? I think the research is still out on that question, right? But there are some challenges, right? What if you want, as a manager, what if you said, hey, how can I make the return on equity? How can I provide a greater return to my shareholders? Well, if you're using this ratio, the only things you can change in this ratio is you either need to increase net income, and I'm sure everybody would like to do that if they could, and certainly they can search for ways to improve that. But mathematically, the only other thing they could do is reduce shareholder equity. Right? So how do you get rid of the owners of the company? So this ratio, even though it is enlightening to say the least, tells us how the company is doing to a certain respect. It still is what sometimes we refer to, it's a little muddy, right? There's a lot of things that you can do to fix this that are not apparent in the ratio itself. So let's look at how we might break that down. Now, this is something called the DuPont analysis. Basically, it says that the return on equity, let's just look at the words up here. If you take the profit margin of the company, and if you multiply it by something called asset turnover, and then multiply that by something called financial leverage, that is how you get return on equity. So let's look at those ratios written out as formulas, right? So if you think about it, net income divided by sales is the profit margin. If you multiply that by sales divided by assets, the sales numbers are going to divide out. So what this tells us then, before we go any further, this is net income divided by assets. And as we'll see in a little bit later, this actually is referred to as return on assets. So now if we multiply this ratio, net income divided by assets, times assets divided by shareholder, again, you can see these divide out, assets divides out. So now we're left with this net income divided by shareholder equity. So now we can answer this question a little bit differently, right? At least we have some more meat to work with, right? How can you increase the profitability to owners? You can increase profit margin. You can run your company more efficiently, use the assets better, or you can find ways to finance utilizing debt. So those are the three tools, and we're going to talk about those as we go through some other videos here. But those are three questions that we can answer about how we can increase return on equity for the company. So here we have some some prominent companies. Some of them we've heard of, maybe some you haven't. But what does this tell us about these ratios? Well, as you can see, we have companies that have relatively high profit margin, right? JP Morgan's 23.5%, but their asset turnover ratio is almost 0.04. So relatively speaking, they are very inefficient at running their operations. However, they also have a great amount of financial leverage. It's a very high number. So if you look at these, right, even though it's 10.8, it seems like it's kind of in the middle here. One of the things this company should be looking at, I would hope, is their efficiency with using the assets that they have. If we look at the number that's the biggest number, right, where are we at? Go down here. Here's Unilever. Let's think of Target because everybody knows Target's 25%. Hasbro's 29.6%. We've already talked about that. You can see that the reason Hasbro is really so high, they're really moderate as far as these numbers, but each number has itself an impact, if you will, on the various levels of management or the varying levels of decision making that management makes. So here's also, then we have Nordstrom and Walmart. So what this exercise asks you to do is to calculate the rate of return on equity and the levers of performance, right? Calculate those numbers that we just talked about. So what I would like is for you to pause this just for a second and try to figure out what these numbers actually are, right? So go ahead and pause, calculate those numbers out, and find out something about the return on equity for these two companies that are competitors. So we're going to continue and talk a little bit more about some other ratios. In this case, we'll start with the profitability ratio. And And in this case, we'll start with the basic one, right? Profit margin. What percentage of sales dollars are realized as profits? And again, it's just net income divided by sales. But as we talked about with ROE, we know that this number is a little, again, the word I'm using is muddy, right? How do you make it better? Well, there's only two line items, right? So you would want to increase net income, right? Find ways to increase. That seems logical, but you'd never want to go and decrease sales. So how do we address this particular number? And there's some other components that we might look at that would help us answer that question. And we'll cover that as we continue on with this video. We talked about return on assets. That's the profit margin times asset turnover. And again, one of the things about this ratio that we just need to kind of keep in mind is that since this number uses net income, it also is a reflection of how much leverage the company has. How much debt do they have? Because if you have lots of debt, you have an interest expense, and that interest expense can obviously cloud, if you will, the actual profitability that the company has. So again, we want to be sure that we don't make comparisons really with companies that have different types of financing strategies, for instance. And that's a little deep for this topic, but it is something we have to keep in mind. When I was talking about breaking down the profit margin, one of the things that we can look at is gross margin. So this is the contribution to fixed costs and profits. So what does this actually mean, right? So gross profit is it's the amount that's left over after we have paid for all the expenses of production. And that's how I like to refer to gross margin, right? It tells us how well management controls the production process, right? How efficient are they? What are the expenses? Now, some of these expenses are fixed and some are variable. Quite frankly, for this type of analysis, we don't need to know that in particular. But again, it's that first step, right? So if you think about the business of the company, the first thing we want to know is what are the expenses of production. If you are a company that's a service company, you don't have cost of goods sold. So this number might not be part of your financial statement, right? But anyhow, the idea here is obviously is to look at how well management is controlling the operations of the company. Moving on. This again is not in the textbook, and I was kind of alluding to this a second ago. There is a ratio that's called the basic earning power. Again, it's not in your textbook, but if you look at the difference between the basic earning power ratio and the return on asset ratio, the thing that's different is financing. So this is EBIT, earnings before interest and taxes. So this number would better represent the operating profitability on assets, right? The ability to produce operating income with the assets that they've purchased. Again, ROA includes financing. So if you're making a comparison between firms, then this return on asset number can be misleading. So here we have a Hasbro, and we're looking at these ratios. We have the profit margin ratio. We know it's around 11%. Return on assets, 10.8%. Gross margin, 55.6%. So let's think about gross margin for a second, right? If you just look at production, right, the company spends a little bit less than 50% of its money. Every dollar that comes in, they are spending roughly 44.4% of their money is spent on producing their products. In the end, when you get to the bottom, there's only 11% left. So what's between these two lines? Well, we have all the other operating expenses that we haven't talked about here. We also have the financing of the company. We also have taxes. So there's a big distance between these two things as far as what's going on inside the company itself. So again, let's continue working our way down our list. So we've talked about this gross margin number, and we want to calculate what's referred to as the break-even sales volume. So again, if we assume that cost of goods sold are variable and that operating expenses are fixed, not necessarily a strict a definition here, but Hasbro's 2016 operating costs were, again, $1.9 billion. Since 56% of sales go to covering the operating costs, right, the production costs, we would say here then that $3.5 billion is what the break-even in sales volume would be. So if you take the operating expenses, 1,968, divided by the gross profit margin, right? The gross profit margin we had up here was 55.6, you would end up with this $3,514 in growth in break even of sales. So what are Hasbro's sales, right? So this is for Apple. A little bit later on, let's keep in mind to come back and look at that. What are Hasbro's sales, right? What are we meeting our break-even point? And I would say, obviously, we are, since they have positive profits. So here's another way to talk about calculating break-even sales. This is for Apple. So again, this is one of those you try it things. So take a moment, pause this video, and calculate the break-even sales volume. What do you need to know? You need to know the cost of sales, and you need to know the gross profit margin. So let's calculate those numbers. The operating expenses are down here. We're assuming they're fixed. Divide that by the gross margin, which is 84,000 here divided by 215. Figure out what that number is, and that will give you the break-even point. When you calculate this all out, I think you will come up with a number in the ballpark of around $61,992. Again, pause this, make sure you can calculate that number. Next, what about our turnover ratios? We have 3 ratios that we can talk about that are pretty important. One's called the asset turnover ratio. We've already used this ratio in that DuPont analysis, but this tells us about efficiency. In this case, sales divided by assets, total assets. The bigger this number, the greater the efficiency. And it's looking at how much money are we generating from sales based on the assets that we have chosen. So one of two, if we decide this number is bad, it is either because we don't have enough sales, which I'm sure we would like more of, or we have too much assets. So that allows us to kind of look deeper in the company to see exactly what we want to do with respect to managing assets. Inventory turnover tells us how many times inventory turns per year. And I think this is a little bit of a difficult number to envision. We have another version of this that's referred to as days carry inventory. So we're going to divide this number by 365 so that will break it down into days, or divide this number into 365. We'll see that formula a little bit later. The collection period tells us how many days on average it takes for us to collect the sales that we've sold on credit. Well, what if you don't know credit sales per day? And I will tell you that unless you are the company, you would never know that number. So what we typically use is the average sales per day. So again, take the total sales of the year divided by 365. That gives you an idea of what the average sales are per day. And we rarely know the credit sales per day. And it's a nice number to understand how our credit granting policies are working. And we want to offer products to, especially to businesses, on credit, right? There's no interest, but this is the way business to business works, right? So again, we want to know how efficiently that's working, and then we can analyze what the challenges or issues are. So next, we have the number of days sales in cash, right? Again, you take cash and securities, divide it by sales per day. This gives us an idea of, based on our sales, right, how much money do we have in the checking account. We also have something called the payables period. This is the average number of days to pay on your accounts payable, what we owe people. And again, what if we don't know credit purchases? Well, Actually, most of our purchases are on credit, but we rarely know that number. So typically we're going to use some other kind of number here. It could be the cost of goods sold number, cost of goods sold on average per day. But again, this is a number we have to understand. As long as we use the same data all the time, it doesn't matter whether we use credit purchases or not. And finally, fixed asset turnover takes a closer look at assets, and in particular asks the question about fixed assets, right? Do we have enough plant and equipment based on our sales numbers, or do we have too much, right? Or don't we have enough, right? So again, once we've decided whether this number is good or bad, we can then ask questions about how do we fix it? How do we ensure that we keep moving in the right direction? So again, these are the videos. We're starting down this road of what's referred to as financial statement analysis. I look forward to seeing you in the next video.